I am on a journey to reach financial independence alongside our audience members. We get together every single month. We vet different passive real estate investments together. We go in on them together, and we bring in a lot of other outside financial experts as well to come and speak both within our co-investing club and also here on the podcast. So today we've brought in Chris Miles. He is an ex-financial advisor. He is also the founder of Money Ripples and the host of the Money Ripples podcast. And when we were talking before hitting the record button, Chris was talking about how, he is very skeptical of stocks despite being an ex-stock trader and an ex-traditional financial advisor. So I was really curious to hear Chris's case against the stock market and against stock investing, given that I invest a lot of my own money in stocks. So, Chris, what's the case? What's the argument against the stock market?
Well, it's bad when guys are like teaching people how to trade stocks and options, come to me and say, "Hey, how do I create passive income doing real estate instead?" Because this is not passive at all. Like I hate working and doing this thing and watching my charts every single day, right? Now, granted, most people don't even do the trading part. Most people are in mutual funds, but
Right.
I'll tell you, like you mentioned, I was a financial advisor before. I mean, when I got into it, I was hoping to give my dad financial freedom, right? That was my big goal. When I got into it, 4 years in, my dad finally reached out and said, "Well, when are you going to become my financial advisor?" Now, understand he was like the penny pinching saver. Like Dave Ramsey probably learned from my dad. That's what kind of saver my dad was. He was debt free, including his mortgage in 18 years. He was stuffing money in his 401k. And then he's like, "All right, Chris, can I do it?" And I'm looking at his numbers. I said, "Dad, you're 61 years old, but if you want to retire today, you better hope you die in 5 years because that's when you'll run out of money." And my dad had to work into his 70s before he was finally forced into retirement. And that's the thing is like it shook my confidence. I'm like, why didn't it work for him? And I started looking at real returns of the market. Like for example, the S&P 500, the last 30 years has only averaged a real return of 8.4%, not 12, not even 10, 8.4. And I've been tracking this for a couple decades now. And I'm telling you, this is the highest I've seen it in 20 years. Like usually it's between 7 and 8%, right? But we were always told 12%. Dave Ramsey says, "You save $100 a month for 40 years, you'll have 1.176 million and you'll be a millionaire. Everybody should be a millionaire." The problem is this, that he's based on 12% returns, right? It wasn't 12%. If you actually put in 8% return instead, you're not at 1.176. You're actually at $370,000 is where you're at.
Are you adjusting for inflation, or are you talking,
No,
gross return?
that's real returns. Yeah. In 40 years, $100 a month at 8% is about a third of that 12%, right? Because that compounding interest works against you when you don't get the same numbers. But secondly, like you're not getting that good of returns, but you can't live on as much either because as a financial advisor, we started to realize the 4% rule was broken. And this was 20 years ago. It's amazing how people are still teaching the stupid 4% rule like it's real. That was created in 1976 before about the time we're taking off the gold standard. Since then, inflation has been worse and people are living longer. That 4% rule is now changed to be maybe a 3% rule. If you're trying to retire early, 2% rule, meaning that if you have $1 million, instead of living on 40,000 a year, you should only be living on 30,000 a year if you're at retirement age, or if you're younger, like 40 or something like that, 20,000 a year. This is the big difference because I had a client where he actually heard me on another podcast, right? Another real estate podcast, followed me, is he met with his financial advisor. He had $1 million in his 401k. Oh, by the way, real stats here. Fidelity has 45 million accounts. Only 810,000 have $1 million or more in them. 810,000. That's a 1.8% rate of success getting to millionaire status, right? Like Dave Ramsey was saying, it would be so easy to do. 401ks have actually there'll be this next January will be 40 years. The 401k has been available to average Americans. Well, here's the problem. Of that same 810,000, that same, 1.8%, 35% were pulled in a different survey saying it would take a miracle for them to be able to retire. Well, why? If you live on 3% of $1 million, that's 30,000 a year. That's not enough. That's what happened to my client, Dan. He was told by his financial advisor, "Hey, you got $1 million in here." Even though he bailed out in the different dips, he was able to bail out at the right times, and get in the market at the right times, had $1 million. He's like, "Well, you're going to live on 30,000 a year." And Dan didn't want that. So he started going to like syndications, did some things with apartments, oil and gas, has some things that we did there, some duplexes. Next thing you know, that same $1 million is now creating over $100,000 a year. It's not about how much money you have, it's about what it's able to create for you. Problem is in the market, it's high risk, mediocre returns, right? You really don't make enough to move the needle. And that's why there's so few people that make it, that become financially free. They have to literally save. Well, in fact, I've done the math. If you factor in inflation, even a conservative rate of inflation, whatever you save per year is what you'll live on per year. So if you max out a 401k at 20,000 a year, you're going to be living a 20,000 a year lifestyle with the real returns of the stock market. Same thing. I mean, like that's a problem. I even had a guy that's markets to real estate investors, and he told me, he's like, "Oh yeah, I hit my 4%. It doesn't matter. It's not enough. And you're still gambling because we're at all-time highs right now." That 30-year period I gave you was from a low in 1994 when it hit a market low to now that market all-time high. It's skewed. And we've had 14 up years for one down year in 15 years, when normally it's 5 years up, 2 years down. We're like overdue for 5 down years right now. It's just a big gamble.
Well, and you're including dividends in that S&P number. Okay, yeah, just right. Making sure.
Yeah, dividends actually are very, very small comparatively nowadays than they used to be. Like now they barely even move the needle from the actual average. Yeah.
The dividend yield in the S&P, it's been hovering kind of between like 1.5% and 3%.
Exactly, it's about mostly been around 2%. That's what it's been lately. Yep.
Yeah. So not a huge yield. People talk about living off of dividends, and that's really hard to do without picking very specific high yield dividend stocks. And and those come with their own problems. I mean, the trouble, you kind of hinted at this a little bit. One of the problems with retiring on stock investments is that those safe withdrawal rate rules, like the 4% rule, that's based on having very, very low risk of running out of money before you die, so that most historical scenarios would have your account balance rise over time instead of drawing down. But that means that by eliminating that risk, you need to save way more than you're actually likely to need in retirement. So and that's where real estate can come in with more predictable income and
tax
returns
benefits too.
Yeah, with the tax benefits. And
the only thing you get with stocks is Roth IRAs, but even then you can only save like $6,000 a year in a Roth, right? And some people are like, "I'll do the backdoor Roth." Well, you know how many times the government's talked about getting rid of the backdoor Roth? I mean, you can't guarantee it's going to be around tomorrow, right? So real estate, you have better tax benefits. And you're right, like with the stock market, you just talk about the 4% rule. That rule now, like they've run the numbers and more people are running out of money before they die with that 4%. That's why it's going down to 3, right? And that's dangerous. I mean, you're right. Like you have to save so much more. That means if it's 3%, if I want 100,000 a year lifestyle, right? That means I have to save 33 times. That's 3.33 million. And I got to make up for the bad performance of the stock market to do that, where I can live on 100,000 a year by making 10% on $1 million in the real estate game, right? So it's not that you have to do one or the other. You could do both. And I have clients that do that, but I just tell people, I'm like, I don't see a reason to have money in the stocks unless, here's the big exception, there's a big crash. If there's a big crash, like another, 2007 through 2009, I might throw some money in to play with, not to gamble on and put my life at risk, but to gamble with, I would totally do that. I did it with crypto. I did the same thing when it would crash after everybody bailed on it. I bought in. And then when everybody was telling me you should buy it, I sold out, but that's how I treat stocks like now.
Well, fair enough. And, I will say I myself do have a significant portion of my net worth in stocks. And there are some nice things about stocks. Liquidity, diversification. It's really easy to diversify your stock investments by just investing in an index fund or, a broad ETF. So there are advantages to stocks, but like you said, Chris, you need to over save for a nest egg made up of stocks, because you just don't know where the market is headed. And, that's a challenge for retirement, having to save way more than you're likely to need. So I love that.
Now even index funds aren't even diversified anymore, because now even SP 500, 30% is all dictated by 6 companies, right? That's
well, you could invest in an equal weighted ETF to get that diversification.
But even then, like that's one thing I realized, because I used to do the same thing, but we realized that usually when one goes down, they all go down, right? So you really don't diversify because it's all paper assets. So I look at it as one asset class and then diversify with like business, commodities, real estate. If you have those and diversify that way, more like what you kind of do in your portfolio, it's much safer strategy to use with the mutual funds and the stocks that you're doing.
No, it makes perfect sense. So Chris, in 30 seconds or less, how do you help people and how can people connect with you if they want to take you up on that help?
Yeah, we got the Money Ripples podcast. You also have moneyripples.com. You can go visit. We really help people how to figure out how to create that passive income, how to actually create an anti-financial plan instead of the traditional financial advisor plan, right? And then even do things like infinite banking and create the best ROI with that too, where you get paid on your money twice.
Love it. Chris, thank you so much for joining us today. And guys, if you enjoy these quick, focused conversations that we have, please rate, review the show. Makes a huge difference to us. And on that note, we'll catch you on the flip side. Want the cash flow, appreciation, and tax benefits of real estate without becoming a landlord? You've heard of REITs and real estate crowdfunding, but you probably don't know much about 5 other ways to invest passively in real estate. So we put together a free video course for you to show you how to consistently earn 15% plus returns from 5 lesser known hands-off ways to invest in real estate. And even more importantly, we'll keep risk front and center in that whole discussion. Because really, what's the point of investing for high returns if you also take on high risk, right? So visit sparkrental.com/free to take our free course. Each video is snackable at 10 to 15 minutes long, and the entire course takes less time than watching a movie. Looking forward to chatting with you from within the course.